The T-line is a highly important indicator for indicating whether the trend has reversed or whether the trend is still in progress. In the case of the Dow, we saw some potential buying yesterday, about the same level it bottomed out before. Today they opened it and started trading higher. However, note what happened right here at close to the T-line. They failed and took it back down. So staying with the very simple rules of trend analysis using candlestick analysis, if you see a candlestick sell signal and a close below the T-line, you're in a downtrend until you see a candlestick buy signal and a close back up above the T-line. The S&P 500 was a little bit more compelling in that it did a spinning top yesterday, but today it came up and failed right at the right at the T-line. It still needs to see a close above the T-line to tell us this downtrend is over. We're in the oversold conditions. A lot of people ask, well, aren't we supposed to be looking for buying in the oversold conditions? That is true. You've got a higher probability of seeing a buy signal occur when we're in the oversold conditions. However, stochastics in the oversold conditions doesn't necessarily mean a trend is reversed. This trend could stay in a downtrend for months, and stochastics could stay oversold for months. What we're looking for is a little bit more diligence as far as seeing a candlestick reversal signal and a close above the T-line. The Nasdaq has a little bit more bullish confirmation in the sense that it actually did a bullish harami yesterday, followed today by bullish confirmation that closed right at the T-line. However, it didn't close above the T-line. So tomorrow's open for all these indexes is very important. If they start opening things lower, that tells us the T-line is still acting as a resistance for the Nasdaq and telling us that they're moving lower after the doji type signals today in the S&P 500 and the Dow, which would confirm that the downtrend is still in progress. Having the ability to recognize which way the market trend is moving also allows an investor to be in the right positions at the right time. Notice on our recommendation to go short in RGLD, we had a big left-right bearish combo right at the 50-day right at the 200-day moving average. The next day, they came up, showed the 200 failed again, and they closed it back below the T-line. Today, they traded it down a little bit lower indecisively. However, this makes for a very simple trade. If it opens lower, you want to short immediately because that implies we're going to have a doji sandwich, which is a high probability trade. If they open it lower after a doji, we know the simple rule of a doji. They're going to move it in the direction of how they open it, which would make this a strong candidate for moving all the way back down to the 50-day moving average. Again, this is not rocket science. This is just looking at what investor sentiment usually does in a trend, and the Japanese rice traders have given us signals and patterns that show us what the high probabilities are for a price move. That'll be it. We'll see you in the chat rooms.